Welcome to the daily briefing from interest.co.nz. I'm David Chaston. Today we review the latest building consent data for October. We also look at what the money markets are suggesting ahead of next week's OCR review, and we'll update what has been happening with those international benchmark commodities, oil and gold. Finally, we'll wrap up with what the other media are reporting. Building consents have settled into a new level of only about 2,000 per month for residential construction. The latest October data shows that consents for apartments have fallen away markedly. In fact, last month's data was revised down from its already record low levels. A look at the annual total shows an interesting trend and a reason why our housing prices have held up to a high and unaffordable level. We've been building less and less housing. In fact, the 25,700 units approved in the year to October is the lowest level in over 5 years. The 2,400 apartment units approved for the same year was also a record low in recent times, and more than a third less than the previous low. This underbuilding we see from 2005 onwards will have serious consequences for affordability. It amounts to a drag on supply, and it is undoubtedly caused by the very high costs of new construction. Limiting land supply by zoning regulation and excessive consent regulatory costs are combining to keep housing out of the reach of a whole generation of would-be homeowners. Next Thursday, the Reserve Bank will announce its latest OCR decision and publish its latest monetary policy statement. Today we wanted to preview this and focus especially on what the money market signals are showing. The OCR is currently at 8.25% and has been since July 26 when it was last raised by 0.25%. At that time, the money markets had correctly predicted this increase, bidding up the 90-day bank bill rate to a level 25 basis points above the new official mark. Immediately after that announcement was virtually no market reaction in that 90-day bank bill rate. For many years, this bill rate has been a very effective market barometer of OCR change expectations. However, things have gone seriously awry since the international credit crunch started to bite in late August. Other international pressures have come into play, generating a rate spike which the Reserve Bank responded to with looser credit arrangements. The international market situation is still very uncertain, but recently we have seen more normal trading. And we are starting to see a steady rise to bank bill rates. They're up 20 basis points in the month since the last OCR review. There is an increasing suggestion here that another OCR rise to 8.5% is being priced into market expectations. Regular users of this service know that we follow the price of two key commodities as markers for international financial risk, oil and gold. The price of spot crude has jumped up close to $100 in the past week, although it is now falling back noticeably. Firstly, Northern Hemisphere inventories are higher than many had realised, and secondly, if the US is heading towards a recessionary quarter, lower economic activity there and in their supplying countries will mean lower demand. It seems that there is now only political uncertainty that is keeping oil prices up. Of course, no self-respecting oil company pays spot prices for crude oil. They buy on forward contracts, and those have been much less volatile than the headline spot price. And that is the real price we follow, 1 month Dubai forwards. Gold is the other marker. It flirted with $840 an ounce, then dropped back to under $800, but more recently has been back up over that level. We now want to introduce a metals price today that actually is important to New Zealand, aluminium. We're a world-scale producer. You need two things in abundance, bauxite and electricity. The Aussies have the bauxite and we have cheap electricity. But this semi-precious metal has not fared so well in 2007. In both US dollars and in New Zealand dollar returns, there's been a steady decline for most of 2007. And finally today, a wrap-up of some other items of interest. Central bankers are becoming nervous that a renewed credit crunch could destabilise financial markets around the end of next month. And the US Federal Reserve has pumped an additional $8 billion into that market to help ease the mounting pressures. The Europeans have pumped in an extra $40 billion worth as reported today. A leading Australian expert on debt has called for reverse mortgages to be banned, claiming they're a big risk to the banking system. Reverse mortgages differ from conventional loans because the borrower initially makes no repayments. Instead, the principal and the compounding interest are recovered only when the borrower dies or the house is sold. The total loan amount grows over time. With reverse mortgages, the lenders are building in an expectation of continued asset price inflation for the next 15 to 25 years. And how realistic is that? You can get more news and stay up with Newsmaker Views on our news page. Join us again tomorrow for the freshest finance news on the web.